Let's get across the market open now. Zach Rios joining us from Banyan Tree Investment Management. Zach, good to see you on this Tuesday. Interesting where we're at. Markets at the moment, things seem to have calmed down somewhat, even though there's no resolution whatsoever with tariffs.
Well, I think I respectfully say this to the US president, either put up or shut up. I think that's where the market is at, as someone put it to me. And we had the sell-off, and then we had the walk back, the 90-day pause, and then discussions happening, not happening. I think we're now getting to a period in the next few weeks where I think we need to start to see these trade deals. There is conversation that India is the first one off the rank. Frankly, India doesn't really move the needle in terms of the trade they're doing. They've got very high tariffs against the US. It would be a very easy win, but some of the more sticky ones, I think I read a headline this morning that the Japanese talks have fallen off again because the US is not agreeable to the terms they put forward. So I think now we're getting to the market. We had the initial sell-off. Now, where everything got thrown out with the bathwater, the baby got thrown out with the bathwater. And in fact, April 9th, I was in Perth doing a client presentation, and I showed two charts to my clients there, and I said, I think this is where the first market bottom is. I'm not saying the market's going to continue to rally forever from here. All I was saying at that point, a chart that we showed, which was basically the number of stocks in the New York Stock Exchange trading below their 200-day moving average, and that was down to 16% at that time. It's up to 30%. Every time it falls below 30%, you normally get a rally, and so we've had that subsequent rally. So, but now we're in the market, now we're in that space, Andrew, where I think we need to see either these trade deals coming through or Trump just calling his own bluff.
So, Zach, what are you watching on a macro front then?
Yeah, so look, everyone's talking about hard data versus soft data in the US. And so, look, the soft data is obviously surveys-based data, people's feelings and views on the outlook. That's obviously very soft. But if you look at real disposable income, which in the US, this is real disposable income in the US. It was up 1.7% in March. And that's a slight acceleration, I think, in February, 1.7%. This is year on year. Real disposable income, as long as this is still growing, that means real consumer spending will continue to grow. And I think in the March month, real disposable spending in the US was 3.3%. So again, pretty healthy levels. And so this is the data that we're looking at along with the survey-based data. So look, I complained about cost of living at every family barbecue, but I'm still spending.
Yeah,
and so that's what you got to look out for. And then if you look at the investment, non-residential investment in the US, this is a chart that we follow as well. No, it's not rocket science. Again, year-on-year growth is about 5.5% for the March quarter. So look, that worm is slowly starting to turn. Now, is that some of Donald Trump's policies of bringing manufacturing back? Certainly, we're talking to companies directly in the US. They continue to invest in their own businesses, manufacturing plants, etc., etc. So maybe this worm is telling you some of the anecdotal evidence that we're hearing is starting to come through. So as long as this is still holding up, the survey-based data, based on feelings and respondents, you got to take it with a grain of salt. That's not to suggest the US economic growth isn't moderating. A lot of it is self-inflicted. But I think there's still enough there both for the bears and the bulls. And it's quite funny actually watching the conversation globally. They are two very strong camps. One thing that we are headed for a abysmal outcome. Others think it's just basically the media overblowing it.
Well, you're saying at the same time traders getting excited about the breadth,
look,
thrust.
I don't. I'm not a technical guy. I am a fundamental guy, but I like to see the technicals. Right? It takes the emotions out, and I like to bring charts like this. And this is doing the right. This is not my chart. This is not my own creation. This is basically doing the rounds globally, and all this chart is showing you is basically the 10-day moving average of the advances over the total movements in the New York Stock Exchange. Very simply put, what this is showing you a very quick movement in 10 days, both from the downside and then the upside. And long story short, there's been 19 occasions. So I told you around 9th of April, we thought there was just way too much. The market had sold off too much, and since then we've had this rally that not many insto guys have participated. Probably the retail guys, buy the dip guys have. Now that very sudden move down and sudden move up has happened 19 times going back to the World War era. And every time on average, it's been up. The market, S&P 500, has been up on average 23%. So there's a few traders getting excited about this, but let me curb your enthusiasm slightly. Those that are bearish have come and pointed out that if there's a recession, some of these numbers don't hold up as well. So, like with any data, take it with a grain of salt, but this is currently doing the rounds.
Well, that uncertainty remains, doesn't it?
Correct.
Meanwhile, what are you seeing locally? And I'm interested, does the election result move the dial at all, or should we still just be focused on what's going on at a macro level here in Australia?
I frankly think it all washes through. One sector that we would call out that probably is likely to be on the nose or will have some interest is the insurance sector, because both political parties went in there they're going to target premium hikes. Premium for motor and mortgage, if my memory serves me right, since 2014 are up like 60 to 90%.
Oh,
so you know, so I think cost of living. I'm feeling the pressure in my home insurance as well. And so I think that's one sector I would say, especially since the Suncorps, IGAs and QBs have done so well in the share price last few years, right? Suncorp obviously because of the capital return and the sale of the bank. That's one sector, but everything else kind of washes through. Let me also highlight another one. I think the Labor Party is saying 5% deposit for the housing, 1.2 million houses by 2029. If you just look at the approvals data, what the current run rate is nowhere near what they need to even hit that 1.2 million data. So what does that approval data rely on? Okay, sure, policy, but it also relies on your local regulation and governments to actually push through the approvals rating. So there's red tape that's holding that up as well. Anyway, so again, we don't base our investments on policy unless it's really, if they come out and say no negative gearing, yeah, I think not that I'm saying that anyone's doing that, but yeah. Locally, honestly, Andrew, what we've been focused on locally and domestic, globally is meeting with companies. We had some really interesting meetings recently, and one that I'd call out is Drone Shield. Had a really good session with the CEO there. The stock had a real massive run to $2.58. It's since come back down. I think everyone would agree that was just a tourist coming in and then just flowing out. But the long-term story for this, where conflicts, drones, both for military and commercial use, that's a story that's not going away. So there's a real structural story here. And then these guys, their first mover advantage, they've got about $2 billion of very qualified sales pipeline. And I think they're gonna at least likely to bank 30, a quarter of that, which has been their run rate. So this is a company that we like the management team, we like the long-term trajectory of the broader sector, and we like their positioning there. They're in over 100 countries around the world, or around 100 countries.